Like I said, welcome back. But it's been the debate of the week, right? And we're going to get the answer tomorrow. Wall Street and practically every other investor has been debating whether it's going to be a 25 basis point cut or a 50 basis point cut. Everybody's in agreement that we're going to at least get a cut, right? So that's good, I suppose. But the first issue looks to be solved to me. We were wondering if the Fed was going to worry about inflation or a weakening jobs market, because you can't fix or worry about both at the same time, right? You either have to keep rates high to combat inflation or cut them to spur on jobs. It looks as though they've come down on the side of jobs. Good for them. Now, my next guest, he looks after the retirement accounts for a lot of individuals, and we wanted to know if he's had to take any preemptive action with his customers in getting ready for tomorrow's Fed announcement. Please welcome into the show Mr. Craig Bolanos. He's the co-founder and wealth manager at VestGen Wealth Partners in Chicago. Craig, thanks for coming on. Great to have you back. What are your thoughts? Well, do you have to? Do you do anything preemptive, or do you have to go down the line and talk to each person individually? How do you handle something like this when we're going to get a big announcement like we're getting tomorrow?
Well, let's be real. For everyone we work with across the country, it's about staying retired once you get retired. And the preemptive work was locking in everyone's bond yields and their ladders well in advance of this event, because we'd long been calling for a minimum of 2 cuts, possibly 3 this year. Looks like we're going to be getting 3. And that's very, very newsworthy in and of itself. So you and I have said on your TV show and your radio program and multiple times, it's last call for great yields. I hope people took their own medicine, heeded that advice, and locked some things in earlier this spring.
All right, so you buy bonds to lock in 4.5%, 4.25%, 4%, depending on wherever you got in for that 10-year yield, or maybe even higher if you did it earlier. But then at the same time, lower rates should be better for asset prices too. So do you have a kind of a mix between bonds and stocks for all your customers and make sure that they're all okay depending?
Well, everybody, bonds are really about staying wealthy. Let's be honest about that, Scott, unless you're venturing into all forms of spread products. So all of our clients are going to have an equity disposition. And I think history is a tremendous guide. And every single time in the past that we've seen the Fed enter into a new rate cutting cycle when markets are at new highs, guess what it did? It just continued to create new highs. If you ask me, what's the danger going into tomorrow for any investors, for clients of VestGen? It's what if we somehow only get an insurance cut? An insurance cut to me would be, hey, we're going to give everybody the quarter basis point that's already priced into markets at a 96% level, but we're going to somehow make a hawkish statement. I just don't think that's going to be happening in any way, shape, or form. And hence, I think we're positively positioned for at least 2, more likely 3 cuts this year and a pair of follow-on acts in 2026. Scott, we're talking about bringing the Fed funds all the way down to 300 or 3%. That's a huge move for anyone who's looking for their eye on the ball or the puck and where it's going to be going.
I'm more in the 3.5% range, because that's where the 2 and the 3-year bonds are trading right now. But that's a whole other show. But I wanted to talk about something you just brought up, which I think is a great point. Yes, we're all going to be watching to see if it's a 25 basis point cut tomorrow or a 50 basis point cut tomorrow. But really what we're all going to be watching is not watching. We're actually listening to what he has to say in the follow-up when the question and answer thing comes on after he decides what he's going to do with rates, correct?
Yeah, that's all that matters. All that matters is the rhetoric, and what really matters is the dot plot. In that dot plot, we do want to see if you're bullish on that part of your portfolio that's in equities. And Scott, let me be clear. Anyone who's trying to stay retired needs to continue to grow their capital base. That means there's some level of equity in people's individual portfolios. So that dot plot and the rhetoric better support 1 to 2 additional cuts this year, and also support, I think, some additional cuts going into 2026, because that labor market is soft. That labor market is soft. To deny that truth, and it's an ugly truth, I think we should be getting in front of it, and it's all the more reason. Do I want to see 50 bips tomorrow? No. If we got 50, the market would take off and rally on that news, but then I think it would be sold because people would be a little bit more worried that the soft landing would be in jeopardy. I think this is exactly what I ordered in terms of my recipe. Hopefully the Fed delivers tomorrow.
You brought up something that I can't stand, and I'm going to say it, I'm going on record. I got a finance degree at university. I was a finance professor, an adjunct professor of finance at DePaul University. So I spent a lot of my time in finance, obviously my whole career. I hate the dot plot. I mean, I feel like I've gone to school and invested so much I've invested so much in finance, and now I got to look at this thing that looks like a Rorschach test. You know, when you unfold it, what shape does that look like? I can't stand it. So that's something that they've introduced. I don't know how long ago, but when they introduced it, I rolled my eyes. So I can't stand that metric. I know a lot of people like it, but at the end of the day, it's just another small tool that people look at. But it's just not one of my favorites, and I'm going on the record to say that I can't stand it.
No, listen, I appreciate going on the record, and it's like all things investing. You know, you don't necessarily get what you want. You got to deal with what you currently have. And I tell you what we currently have. We got a dot plot that's coming out, and we still have a recipe that looks like it's a soft landing. Boy, I like it.
Yeah, I agree with you. All right, brother. Great to have you on. Thanks. Great to have you back, too. Craig Bolanos. He's the co-founder and wealth partner of VestGen Wealth Partners in Chicago.